Anand Radhakrishnan, Managing Director and Chief Investment Officer with Emerging Market Equities, and Franklin Templeton joins us now to take our conversation forward. Anand, good morning. Thank you for joining us.
Good morning.
Just when things were looking settled, US Fed has set cat amongst the pigeon by saying that the war is not over and it could have collateral damage on the economy in the near term. So are we going back to that same ugly template, a fear of slowdown and a real risk of high energy prices coming back in winter?
While the battle with the inflation is like half won, I think the Fed chairman's comment should be seen in the light of what is more in store. I think if you dissect the inflation globally as well as in US, uh, at least the half the drivers of inflation is cooling off, which is inflation coming out of manufactured goods, inflation that is driven by metals, inflation that was driven by bottlenecks in global logistics, shipping, ports, etc., are significantly cooling off. And we might have seen the worst of that and the peak of the manufactured inflation already. However, I think the other track of inflation, which is services inflation, which is driven by employment, wages, rent, etc., is still raging, and I think they are yet to peak out. And in that sense, the battle is half won, if I may say so. So clearly, the commentary kind of puts in light the challenges that are there in front of Fed, how they are struggling to kind of effect an orderly wind down of inflation without affecting the macroeconomic stability, the market prices, the volatility in asset prices, etc. But having said that, I think I would say that it is not that we are going back to square one. Significant policy actions are already in motion. We have seen a near normalization of interest rates to pre-pandemic level, but we are yet to see the liquidity to normalize. Probably it may not normalize in any near term, but at least directionally it will trend to go towards that. And once that is in motion, we would see probably the inflation fears calm down. I think the consensus kind of predicts that by the end of the current calendar year or the early next year, the peak should be behind us globally as well as locally.
Anand, but what does it do to the market? This morning, Uday Kotak, in his usual style, tweeted, and I'm going to read it out to you, saying that the Fed Reserve Chairman Jerome Powell has finally spoken firmly to fight inflation. He says it reminds us of Paul Volcker, who broke the back of US inflation in 70s and 80s. Watch out for quantitative tightening now. He says US rules the financial world. Opiated markets will wake up and smell the coffee. I want to talk about the market part here, Anand. And does it seem like, maybe not even June lows, there could be some serious correction in the market? Because up until now, the markets were, assuming that inflation is going to be transitionary in nature and central bankers are going to, rein in very soon.
It's a colorful tweet, I should say. But, one of the drivers of in the inflation is essentially the tight labor markets as well as the property prices. If you look at in US, which is where the bulk of the global equity markets seem to be pivoting towards, US inflation, US macro, US markets, etc. I think the property prices are still, the median home prices, which we normally track, is 30 to 40% above their pre-pandemic levels. And even specific states like California, I was talking to a few of my friends and relatives, is upwards of 70, 80% the median home prices. And this has an impact on the pass-through inflation, the wages, etc. And this is driven by record low rates, record high liquidity, etc. And therefore, it will be very interesting to watch how inflation is brought under control without impacting the high property prices, the tight employment that we have seen, and high wages as well. So yes, there is significant challenges. It has to climb, as I say, the wall of worries into the next 3-6 months before we can clearly call out. Market every now and then will try to be brave about it. Will try to hazard a guess, and therefore we should be prepared for that amount of volatility. Now, one of the thing about the policy making is it is half numbers and half expectations. So it's Fed chairman's and the other policymakers' duty to talk down the expectations, to bring down the inflation expectation, to make it more sobering for people to place their bets, if I may say so. And those are, I think, part of the it's a verbal communication which goes hand in hand with the policy communications.
Okay, inflation aside, Anand, that morning I wanted to talk about the overall portfolio and financials. Large cap financials, those definitely stand out, the likes of Axis, HDFC Bank, and ICICI Bank. A recent sell, though, has been SBI. So it's a conscious call then to stick with only the large caps?
Now, within the Indian banking sector, I think the sector itself is pretty favorably positioned after having gone through a huge NPA cycle, high provisions, etc. I think we are on the cusp or the verge of starting in the new credit cycle. The credit growth numbers seem to be pointing towards a healthy resumption in the credit growth, driven by both working capital demand as well as capital expenditure demand. So we are very early into credit cycle, and I think there are enough data to suggest that the banking sector has gone through a fair amount of consolidation, and the top 6-7 banks have kind of gained market share over the last 5-6 years, both deposit market share as well as credit market share. So I think our predominant bet within that sector has been with the large banks which are both well positioned both in corporate credit as well as in retail credit. I think both growth as well as cost will be tailwinds for the banking sector, and their valuations are kind of around the median, unlike some of the sectors where the valuations are well above the median valuations. And that gives a lot of comfort to allocate a fairly large proportion of the portfolio.
And over the years, what I've realized, and you're an expert here, is that large part of the gains are made because of re-rating and large part of losses are adjusted because of de-rating. So for next 2-3 years, where do you think markets are going to go through a process of de-rating and re-rating?
I think re-rating, de-rating goes along with the growth cycle. When the growth is good, you get that double benefit of growth being good as well as PE kind of getting PE or price to book getting re-rated upwards. And similarly, where the growth is kind of cooling off or less or negative, we also see kind of the stocks go through de-rating. I think what we have seen in the recent times, sectors like automobiles, banking, domestic capital goods, industrials have seen some kind of a growth coming back, and valuations are getting progressively re-rated. Some of the global cyclicals like metals, IT, healthcare, where we have seen growth beginning to taper off, we are also seeing valuations getting derated.
Tactically, would it make sense to steer clear of globally linked sectors, metals, IT, and perhaps look inwards and look at domestic cyclicals, perhaps?
That's a fair point. I think as the global growth remains murky, the global macro remains volatile. It is intuitive to kind of turn inwards, where India seems to be in a relatively better position both on the macro side as well as on the bottom-up story growth side. So pivoting portfolios and investments to domestic growth ideas seem to be a pretty solid strategy with less uncertainty.
Huge debate when it comes to new age tech. I see a fresh buy in the portfolio is Zomato. The company clearly waking up, smelling the coffee, taking cognizance of profitability, which has been a huge roadblock. Do you think that, the long-term story obviously looks intact, and would there be any other stocks within this space? Because across the board, we've seen companies really change the narrative.
In the new age tech names, we have seen multiple themes emerge. I think Fintech, EduTech, Health Tech, Food Tech, if I may call Zomato as one. have all come to kind of either disrupt the existing model of business or create new business models with some value delivery to the clients, and therefore making some profit motives around that value proposition. I think some have a more clear, well-defined value proposition, and therefore have a better chance of becoming reasonably good, profitable franchises over a period of time. And we believe that Zomato is one, because it makes food delivery a convenience option to their customers. It helps people to discover new cuisines. It helps people to avoid traveling distances to restaurants and for dining out, etc. So in that sense, it's habit forming. A lot of younger generation people are adopting to platforms like Zomato, Swiggy, etc. So if you look at it, the bigger picture, I think the stars are well aligned. The coffee should taste good over a period of time.
Just to wrap it up with one view on IT, this traditionally has been a sector where you've had ownership for years and years now. We are getting confusing signals. While companies are acknowledging that there is an attrition problem, they're also sharing with us that there is no demand problem. Where is that piece headed? Because historically we've learned that every time when there has been a global recession, IT spend, it tends to get affected. IT stocks, they get crunched by 50 to 60%.
There are two big wheels in motion, or two wheels in motion. One is a bigger wheel, another is a smaller wheel. The bigger wheel is this constant pressure on the global companies to kind of reduce cost, take out cost, outsource, etc. And there are smaller wheels where a lot of companies spent a good amount of money on short cycle projects, which are aimed to handle the disruptions that came out of COVID pandemic, etc. I think what we are seeing is a certain kind of running down of the short cycle project. We will see probably in the next couple of quarters the numbers beginning to show the short cycle projects beginning to come down, which these short cycle projects put pressure on the labor market, led to wage increases, significant employee churns, etc. Many of these things will cool off in the next 2-3 quarters. We are already seeing early signs of that. So the pressure on the companies on margins, on wages, and recruitment and attrition of employees should significantly ease up in the next 2-3 quarters. The bigger wheel, which is cost takeouts, I think outsourcing is constantly in action, and I think there the Indian companies are relatively well positioned. So I think what we are seeing is the market prices adjusting to the nearer term cool down of the short cycle projects, and then also without losing the sight of the longer term opportunities. I think at some point of time, I think the sector will kind of bottom out in terms of nearer term growth and will start to look up. And one should therefore, we would like to remain very, very constructive. Many of these companies are extremely well run, high cash generative, good dividend paying, very disciplined on capital allocation. And therefore, we would like to remain very constructive on this sector. Maybe there is a time effect out there. Time should roll off maybe another 3 months to 6 months max.
Sure. Anand, great to have you on the show today. Thank you so much for taking the time out and joining in. Just want to revisit what the market has settled in at. And you haven't seen any signs of the gap down getting bought into. We're still down about 1.5%, actually more than that. 17,266 is where the Nifty is. Reliance is falling a lot less as opposed to the other large caps. But yeah, look at metals, look at IT, look at banks. They're all getting washed out in trade. Reliance is recovering, and I guess that is what is reflecting on the Nifty, frankly.